Hello fellows, welcome to my channel. This channel is entirely dedicated and created for educational purposes only. Here you can find high quality educational materials to learn the basics, whether you are a beginner, more advanced or an intermediate trader. For people that want to see more action, you can check the link on the top right corner. Here we are proving our methods with real accounts. We trade for several years and we show that it can be done profitably. You can subscribe as all profits go to our subs. You can find all the details about our accounts. However, since you are new in trading, using real money is almost forbidden. Practice will make you better, and do not expect fancy cars and fake promises. Trading is real challenging and the numbers are against you. You won't need any money to start and everything is totally free. For most of our videos, you will find a link in the description that will lead you into a more advanced version of the video, but as beginners, I do not recommend. Stay with the basics and demo trading. So let's begin your journey. Most new traders want a cheat sheet of the best chart patterns. Well, this episode is exactly what you need. A chart pattern is a recognizable shape formed by prices. There are several types, more advanced ones, and some simple patterns. Some of them make sense to use as most traders also identifies them in the market. The most popular a pattern, the most likely it is to work. The market is a self-fulfilling prophecy. As we said, chart patterns are part of technical analysis. Here we will see some classic pattern formations. Pattern formations will help you to spot these juicy trades that probabilities will be on your side. Patterns will help you understand what will happen to the prices. Again, some of them will make sense as they are based on price action and behavior, buyers and sellers. Other patterns, more advanced, that uses golden ratio, for example, are debatable, and that's why we are here. In this episode, we will give a useful review of the most common ones: double top and double bottoms, triple tops, triple bottoms, head and shoulders that is not a shampoo, and inverted head and shoulders, wedges, rectangles, pennants and triangles. You might think that you are doing geometry and random lines, but trust me, there is a logical explanation for these price patterns, and you will see what I mean. Double or triple tops and bottoms warn us that a reversal might has begun. Double tops and bottoms are important technical analysis patterns used by most traders. An M shape for the double top and a W for the double bottom. There might be cases in which you might have more than two tops or bottoms, as the prices try several times to break the same level. At some point the market is trapped in those areas, forming channels that we will see later on. A double top is a reversal pattern that it is formed after the prices are moving up. These tops are critical levels that eventually the buyers didn't manage to prevail. After hitting this level, the price will bounce off it slightly, but then return back to test the level again. Now in theory, many traders are looking for symmetry or a well-shaped M or W and so on. Indeed, the more distinguishable is a double top or bottom, the more traders will jump in. We trade them with a very simple way. In this double top, we are putting our entry below the neckline, as we call it. We put our take profits in this area. We calculate a risk to reward 1-to-1. We will see later on how to pick risk rewards. The drop is approximately the same height as the double top formation. Looking at the chart, you can see that the price breaks the neckline and makes a nice move down. Double tops are trend reversal formations, so you will have to look for these after there is a strong uptrend. Unfortunately, the poor risk reward ratio and the way that the market moves in a direction makes them pretty unstable. That's why we created this series, to show you the best practices. So when you have noticed a trend, you have plotted your MA, your oscillator informs you that the market is running out of steam, and you see a double top or bottom, then it's an extra confirmation signal to enter the market when the prices start closing beyond the neckline. So use them as extra signals and don't trade them directly. Of course, we use the same principles for double bottoms. Another easy to spot pattern is the head and shoulder. The head and shoulder consists of a baseline with three peaks, the middle peak being the highest. The head and shoulders pattern warns us of a reversal. The inverted head and shoulders is exactly the opposite version in a downtrend. Like all pattern appears in all time frames, most traders will notice them, so you need to learn how to identify them. Again, you will find in the description a more advanced version of these patterns that we are showing in this episode. Many traders confuse head and shoulders with the crown pattern. We will see it in the future episode. A head and shoulder pattern is formed by a peak, shoulder, followed by a higher peak, the head, and then another lower peak, the second shoulder. A neckline is drawn by connecting the lowest point. The slope of this line can either be up or down or in the same levels. Typically, when the slope is down, it produces a more reliable signal. Again, symmetry is what we need to check. Most of the time patterns won't be perfect, and of course no one can guarantee that they will work. We trade this pattern by entering our trades below the shoulders, and our target is the same height from neckline to head. Again, we do not trade this pattern directly. The risk reward in this pattern is much higher, which makes them more appealing to traders. We need to use them by combining them with more signals. The inverted version is exactly the opposite in a downtrend. The higher the distance from neck to head, the more appealing it becomes. Again, in the description you will find more details about how buyers and sellers are acting and how we get finally this formation. Wedges are the most common patterns and the ones that can mislead you as the market is live. Simply, there are two trend lines that converge. The magnitude of price movement within the wedge pattern is decreasing. Again, as we said, this behavior can be explained and you can find a more advanced version for each pattern we are describing here. Wedges signal a pause in the current trend. In these areas, we have indecision. There are two types of wedges, ascending and descending. An ascending or rising wedge is a bearish chart pattern that can be found in a downtrend, and the lines slope up. A falling wedge is a bullish chart pattern that takes place in an uptrend and the lines slope down. Wedges can be continuation or reversal signals. When the distance between buyers and sellers is getting smaller, the market bullish momentum slows down. A breakout is what we should expect. A rising wedge is formed when the prices consolidate between upward sloping support and resistance lines. The slope of the support line is steeper than that of the resistance. This indicates that higher lows are being formed faster than higher highs. This leads to a wedge-like formation, which is exactly where the chart pattern gets its name from. Even though the market managed to move higher, the sellers are eager to dive and short the market earlier. This creates the wedge formation. Notice how the higher highs are not the same like when the market is trending. A rising wedge is a signal that when the market tries to move slightly higher than the previous stop, more sellers are going in. This eventually crashes the market while failing to move higher. The opposite is when we are facing a falling wedge. Now, how we trade the wedges. When the prices breaks the wedge, we enter the market. Our take profit is exactly the same distance as the first formation. Wedges can give really good risk rewards. The problem is that the market is moving in such a way that they can mislead you. Again, I have used perfect examples, but when you are trading a live market, you will get fooled several times. In time and experience, you will be able to identify the patterns faster. Again, use them as signals to enter your trades. The same principles applies in a falling wedge. The rectangle is another classical pattern described by two horizontal lines, showing significant support and resistance levels. It looks like the prices are trapped in a channel as buyers and sellers are into an agreement. Price is bounded by parallel support and resistance levels. Rectangles are price continuation patterns. As the market moves into a direction, suddenly the opposite function is intercepting the market. Eventually, and most of the time, the market will keep moving in the main trend direction. That's why we said that trend is your friend. The price will test the support and resistance level several times, and eventually it will break out. At the beginning of the formation, you might think that it is a double or a triple top. However, that's why, as a trader, you need to be patient. A bullish rectangle is an area of consolidation during an uptrend, while a bearish is the opposite in the downtrend. Again, we trade based on the height of the rectangle. After the breakout, we put our profit taking in the same height. Now, many of you might ask why this is so similar in so many patterns. Well, the idea is very simple. The same amount of buyers or sellers will potentially move the market. Again, do not trade this pattern directly. Use them as an extra confirmation signal to enter a trade. They are formed when a market makes an extensive move higher or lower, then pauses and consolidates between converging support and resistance lines. These are similar to wedges, Pennants are continuation patterns. After a big up or down move, buyers or sellers are starting to equalize. The opposite function is jumping in but doesn't manage to prevail. In this area, the market is taking a breath. Pennants are continuation patterns and they occur after a big move. A bearish pennant is formed during a steep, almost vertical downtrend. After that sharp drop in prices, some sellers close their positions while others decide to join the trend later on, making the price consolidate for a bit. As sellers are jumping again, what we should expect is the same move in the same direction. Pennants can give big risk-reward ratios, but again, they are not perfect. Many times you will get fake breakouts. No matter how prepared you are, the market will trick you, even if you wait for some bullish candle confirmation or a retracement to enter, and so on. In any case, we do not dive into the market right away when a simple spike breaks the pennant. As new traders, you will have issues identify them, and like all patterns, when you change time frames, they will disappear. Nevertheless, it is a powerful tool. You can find another video in the description with more details in case you want to check. At the start of its formation, the triangle is at its widest point. Triangles are among the most common formation you will see in the market. Triangles forms when buyers and sellers are jumping earlier into a price movement. This gives the triangle the shape to the price behavior. The triangle pattern is a continuation pattern. In theory, we need 5 points to verify a triangle. But the market is not perfect and you need to understand the idea and how triangles are formed. We have 3 types of triangles: ascending, descending, and symmetrical. An ascending triangle occurs when there is a resistance level and a slope of higher lows. There is a certain level that the buyers cannot seem to exceed. However, they are gradually starting to push the prices up, as we can see by the higher lows. The rejection of the prices is getting smaller, and eventually the prices break above. As the prices test the resistance level, the stronger it becomes. There might be a case that eventually the prices don't manage to break above. You might experience several fake outs. Most of the time, the price will, in fact, go higher. The way we trade is similar. We enter the trade above and the target is the same with the highest swing. A descending triangle is exactly the opposite. We are expecting the prices to go lower as sellers keep pushing, while buyers are unable to respond. Symmetrical triangles are a bit more tricky. The slope of the price is high and the slope of the price is low converge together at the point where it looks like a triangle. The market keeps doing lower highs and higher lows. Neither the buyers nor the sellers are able to move the market enough. This is another type of consolidation. Symmetrical triangles are trend continuation patterns. An entry order above or below the slope depends on where the trend is coming from, and our target would be the same as the highest swing. As we progress in our series, we will see several types of patterns and some more advanced ones you need to know. Let's try to sum up. There are 3 types of patterns: trend continuation, reversal patterns, and patterns that indicate that the market might go either way. So, reversal patterns: double top and bottom, head and shoulders, and inverse head and shoulders, rising and falling wedges. In the second category, continuation patterns indicates that the market will continue in the same direction, and these patterns are consolidation patterns. If you think of it from a supply and demand perspective, these are obvious areas that the market is taking a breath. In this category, we have falling wedge, bullish rectangle, bullish pennant, rising wedge, bearish rectangle, and bearish pennant. In the third category, we have the triangles: ascending, descending, and symmetrical. The third category consists of patterns that we don't know exactly where the market will go. I know you might be confused. Well, trading is not easy. The reason is that those patterns are not always accurate. You might have several false signals and fake outs. In a future episode, we will see more advanced patterns, but for the moment, these are the most important ones. Chart patterns are a very useful tool. The reason is that as most traders use them, most likely to offer us a better entry and exit point, it will take time to identify them and several new traders won't get them very easily. The market and the way it is structured will play tricks on you. Patterns will disappear when you change time frames. When you are learning new patterns, your brain will play tricks on you. You will try to identify them desperately in the market. In the end, I'm afraid there will be some random lines that crosses the prices. Our brain tries to make patterns when it sees something that cannot identify. You will see them everywhere, even though there might be nothing there. You will keep changing time frames until you spot one. In other words, you will lose the market and huge moves by searching for them. As we said, you will have several fake signals. Also, as the market is chaotic, eventually all kinds of shapes will be formed. Patterns are a very powerful tool, but do not trade them directly. Use them as confirmation signals to help you with your trades. In the description below, you will find the more advanced version of each pattern we mentioned in this episode. Again, thank you for watching. Go back, repeat the chapters you are not sure, and trade safe. So that's it for now. Thank you for watching our videos. I hope you enjoy. You know that we need your subscriptions, likes, and comments for the YouTube algorithm. Help us to make more content and trade safe.